This is foretelling us the coming of a new world monetary order.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. This is the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. And we have exclusive access to experts and insiders, and we reveal information, we reveal insights that you simply won't find anywhere else. Hi, my name is Shane Morand, and I'll be your host for this week's episode. And we'll be joined very shortly here by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of gold and silver markets and expose what's really going on in the precious metals industry right here on Live from the Vault. So get ready for another blockbuster episode of Live from the Vault, and we'll bring you the knowledge and the understanding that the mainstream media will not provide. So just before we head over to the UK, please help us spread the word by hitting that like button right there. You know, like the channel, share the channel, and if you haven't already, hit that bell. If you want to be notified in real time as each episode goes live, just hit that bell right there. And with that, let's head over to the UK and talking gold with Andrew Maguire. Now, Andrew, as usual, we've received a ton of subscriber questions and comments after the last episode just 2 weeks ago. You know, it seems more and more like these 2 weeks are like 2 months or 3 months, but just 2 weeks ago, where you warned the speculators that were playing with fires and making massive bets against the house. Now, it looks like exactly what you just said played out. And can you just update us again on exactly what's going on for those that saw you last time and for those that are just joining us here for the first time?
Yeah, well, it's great to be with you again, Shane, and great to be with everybody, new and old subscribers alike. Really, everyone's so welcome here. This is about trying to provide just another side of the narrative, a wider picture. And it's all about information, gathering information for people to make their own decisions. So really what we can do, I mean, Shane, you're right. What you were referring to just now was this synthetic disconnect that had resulted from these momentum-driven speculators. Remember, we were going down and down and down, and they have just no visibility into the physical markets. So what they do is borrow paper gold warrants from the house and then sell them. And simply speaking, a warrant is little more than an unleveraged, undeliverable IOU, basically. But as our subscribers are all too well aware, the paper gold supply is being conjured up out of thin air, and it has no gold at all or silver backing them. But there are historical inflection points where these overshoots become so large, they backfire. Now, hence the playing with fire comments. Now, the reason we've drawn attention to this extreme paper to physical market disconnect was because it was the absolute opposite of what we were evidencing in the extremely strong for demand wholesale physical delivery markets into this sell-off. Now, these inflection points result in COMEX-driven gold price overshoots, which are the direct result of leveraged paper supply meeting unleveraged physical demand. But with the house clearly betting against the speculators, this is why we said this one was actionable. And as we drew attention to when we recorded the last episode, it was on the 3rd of October, yeah, by the end of September, this extreme structural disconnect was mirroring a very similar paper to physical market inflection point that we had not evidenced since the Bank of International Settlements used these useful fools to buy back every single ounce of over 500 tons of loaned paper gold positions against them back in November. It was November 2022. As these blinkered speculators chased, again, a dot on the screen. They have no visibility into anything other than this dot on the screen. And They chased it down into the 1600s, if you remember, back in November, which was the exact point that this mega central bank, the Bank of International Settlements, rang the register on them, buying back and squaring their last few remaining central bank derivative bets at a price close to $300 below the current price range. Now, yes, folks, I mean, we're talking 16 million ounces of physical gold loans that this central bank of Western central banks was able to lay off on these speculators at an almost identical structural inflection point to what we just saw now. Well, is it a coincidence? That they are $4.8 billion better off now and growing? Not a chance. But more importantly, really, what is this actually telling us? This is the key. So just connect the dots. On the 1st of January of this year, overriding massive objections from the officially sanctioned US-centric gold cartel, and they really did object to these the physical backing of gold, the Bank of International Settlements actually enforced against them and against everyone else the necessary Basel III NSFR structure required to recategorize physical gold as a first-tier asset class. But in order to qualify as a first-tier asset class, the Bank of International Settlements had to ensure that the global liquidity providers who make these markets in this 10 times larger than the COMEX foreign exchange gold marketplace had to have physical gold to back up their offerings. Otherwise, how could it be considered to be a first-tier asset class? So since November 2022, the Bank of International Settlements, with every other global central bank except the Fed, want a higher gold price, as does every single bullion bank, without exception. So this beggars the question, why the heavy action in September? And what was missed by the mainstream media? And goodness me, watch Bloomberg all day, you listen to this stuff. No, the only time they ever mention gold, it seems, is if it's coming down. And even with the current geopolitical escalations, how rarely gold, in fact, gold doesn't get mentioned. And what is missed by this mainstream media, and of course the bought and paid for analysts, is that gold now competes with treasuries. This is the key. And given the tail risk associated with treasuries, namely insurmountable debt backed by faith alone, first-tier physical gold has become a central bank and sovereign and institutionally sought after risk asset class. It competes. And it provides global central banks and sovereigns, and those simply hedging risk, a far superior and the only zero counterparty risk asset class anywhere. And really, what this is doing, it's foretelling us. This is a change. This is foretelling us the coming of a new world monetary order. And we are privileged to be witnessing this inflection point where Nixon's temporary suspension of the dollar's convertibility into gold some 52 years ago has been reversed.
Yeah, Andrew, now this has been a long time coming. And you know what? Let's step back a little bit. And as you again predicted in our very first Live from the Vault episode back in 2023 of this year, when Basel III NSFR standards were enforced, you figured that by the end of the year, which is the end of 2023 right here, we would see real physical gold and maybe even silver prices begin to emerge.
Yeah, Shane, and in fact, just as we were discussing before we started the recording here, the real subject actually of this episode is to look at why the COMEX, the only non-compliant gold and silver market exchange, if it wants to survive, that is, will be forced to comply with Basel III NSFR conditions in 2024 and ultimately become physically backed. And we'll look at how this effect will run over the Fed in 2024 shortly. But I know you had some shorter term subscriber questions, Shane, so we can put them in the right order.
All right. Yes, Andrew, we're really looking forward to that. But first, given the massive volatility we've experienced, we've had so many questions from subscribers that are looking for guidance on what you are seeing right now and what we should expect more in the immediate future here.
Yeah, a really good idea at this point. Let's start by looking at the conclusion. This is the elephant in the room for most people. Let's look at the conclusion of September's month-long, right from the beginning of September, right to the end of September, this COMEX-driven paper, gold, and silver market selling, which actually wrong-footed and disheartened so many people. But let's observe how under the radar of the momentum-driven sell the rally stance that had been created, we had evidenced a distinct bullish change in market behavior. With these myopic traders who they'd failed to detect this change. And as they raced headlong into and beyond the insider's predetermined multi-billion-dollar options expiry trap. So to answer the question, we'll also look at why this change in market behavior is not just another short-term cycle, because that's what people think. It'll just go on and on and on forever. 50 years of it, you can understand people's thinking. Now, siloed COMEX momentums, whether they're long or short, doesn't matter where, they're always wrong at both ends of a synthetic paper market rally or sell-off. Nothing to do with supply demand of real physical. So by design, following being banned in 2013 from being able to even access the physically deliverable global over-the-counter foreign exchange markets, US traders have naturally become blinkered to what is really occurring in the 10 times larger, and now, since the 1st of January, as you say, NSFR compliant deliverable over-the-counter gold foreign exchange markets. Now, in any marketplace, whether it's a village market stall selling farm produce or an exchange selling gold, it makes no difference. Every transaction has a buyer and a seller, and the price is determined by an equitable balance between supply and demand on that day. However, not so in the COMEX gold exchange, where the goods are never intended to be physically delivered. They're just temporarily loaned, and get the word, loaned to a speculator on margin who hopes to return the goods at a more favorable price than he borrowed it for. Now, that could be higher or lower. It was never intended to be a physical delivery. But the house can, at will, generate as much or as little of these loaned promises sufficient to control the supply-demand price. Distort it, in other words. So as nothing ever gets delivered, the supply-demand balance is rigged synthetically to very closely resemble a casino's 95% win ratio. Hence, we call it the casino, that it is. And yet outside the COMEX casino bubble, led by the speculators, are completely unaware they're merely trading against the unseen, carefully managed physical leg that the house has lodged outside the containment bubble. In other words, they just see the half of the picture that the house wants them to see, and the reports that we get prove that. And we'll look at that in a little while. But this is fine. This is a fine balancing act. And it's really limited, though, to how many speculators can be fooled into borrowing these brilliant hedges from the market-making insiders. And with no visibility into what these short bets actually represent, namely a myopic bet against these house-held hedges, they don't even realize that they are, the multi-year speculator-powered wash and rinse cycles have been enabled since the COMEX was formed over 50 years ago. But as we will assess, thanks to Basel III compliance now forcing the long foreign exchange leg of the COMEX shorts that the speculators see, that's all they see. But that hedge is actually, that COMEX position is a hedge against a real physical position, which have become deliverable. And the closer we approach the end of the fourth quarter, our very well connected first tier liquidity providers report that the physical markets relied upon to underpin this fractionally settled COMEX trade will become far too thin to be able to last beyond the fourth quarter of this year. And this is 100% driven by an unfactored physical market phenomena. Since the 1st of January, Basel III NSFR regulations have forced global spot market liquidity providers to have the physical bullion on hand to deliver on request, T+2. That means I go to the spot market, I demand delivery, I get it in 2 days, assuming it's not bilaterally settled at a higher price because it's a larger order. So within reason, I get it. Now, what that does is eliminate the historical friction of a central bank or a sovereign demanding physical delivery from this 10 times larger than COMEX foreign exchange global price setting gold market. And therein lays the problem for the scope of the COMEX driven wash and rinse cycles. Each ounce, kilo and ton of gold underpinning fractionally held COMEX hedges that exits the CME LBMA ring fence further limits the scale of these historical wash and rinse cycles. Competing central banks and sovereigns are actively converting paper market synthetic output prices into physical and removing it from this CME LBMA ring fence. So far too much bullion is exiting the casino to enable these cycles to get sustainable synthetic market traction. In other words, insiders are running out of enough speculators to be able to offset their delivery exposure in this 10 times larger global foreign exchange market. Now, while these types of synthetic market price disconnects have largely been able to be managed by the officially sanctioned market-making insiders, privileged to have footprints in both markets, there have been several events over the 50 plus years paper market history where this paper to physical disconnect has become untenable. And we're once again at this juncture as we head into 2024. Only this time it's different. Following foreign exchange over-the-counter spot gold becoming NSFR compliant in January, the frictionless ability for competing central banks to alchemize synthetically priced gold into deliverable physical bars has reached this inflection point where far too much paper liquidity has exited this non-deliverable COMEX exchange to really continue to contain this borrowed paper gold in a meaningful way. In other words, each wash and rinse cycle is resulting in higher price stair steps.
Now, Andrew, you've been outlining now for several recent episodes, and you said it again today a couple times. Now, the Fed is the only central bank trying to cap the price of gold. You know, something has to break, does it not?
Yeah, Shane, and therein lays the problem for the wrong-footed Fed, which is, as you say, the only central bank still net short paper gold. Their efforts to continue to concoct a synthetically priced gold benchmark to support treasuries and the fiat-backed dollar is this foreign exchange markets. They rely on ensuring that this COMEX-derived gold price continues to be siloed and squared inside this non-delivery COMEX bubble. What spills out is a problem. And while the House can rig the shorter-term ranges, for the first time in LBMA's history, liquidity providers report that so much of this fractionally held bullion underpinning the leveraged casino chips loaned to the speculators, which is measured in CME terms or COMEX terms as open interest, but it's just chips. So much of it has flowed out of the CME LBMA ring fence that there is insufficient remaining paper market liquidity to keep this 50-year confidence trick running for much longer. This is telegraphing, as we enter 2024, the plus 50-year COMEX dinosaur will no longer be fit for purpose. It has reached an inflection point where it will either have to reflect a deliverable gold price, or, and it could be silver, or it'll be robbed of every leveraged ounce. Really, where's the solution there? Of course they don't want to fail. They'll have to back it. So faced with this situation, and the Fed relying on this market to contain gold, paper gold, what are their options? So really, they've got some choices. Adding paper gold, paper market open interest, adding more than can be laid off on the captive speculators, will result in this excess leveraged non-delivery paper warrants being EFP. Do you remember EFP is? It's 60 in exchange for physical. It's a little back door that the COMEX has. If I want to take delivery, I want to take a COMEX position, I can move it into the deliverable markets through the EFP backdoor. We see tons of it going on. People don't realize what's going on here. So, because what's happening is then, if you put too much out there, then these warrants then are converted into physical in the NSFR compliant Basel III physical delivery markets. Hence, the COMEX market making insiders have to literally race in to ring the register on the speculators far earlier than they would have liked, really limiting the scope of these counterintuitive sell bots. And they are bots. They're high frequency trading bots.
All right. Now, Andrew, you just talked about open interest. You discuss as measured in the Casino in the House COT report, and that you drew our attention to this telegraphing of the specs were in great danger. Can you discuss this again, please?
Yeah, Shane, really important. As you know, we had evidenced this in the last 3 COT reports, actually, where the predatory swap dealers, that is the official Fed agent banks, had uncharacteristically gone long, and in other words, bought back these short hedges that we talked about, which are hedging their long physical positions. They bought them back against the specs, but it was before and just ahead of large market free falls. Now, that is most unusual. This was a major anomaly, telegraphing the paper to physical disconnect had reached limits, that the kind of limits we're just referring to. And this is because none of the first-tier market-making bullion banks who have the physical gold exposure to these short hedges, they don't want to expose themselves to delivering bullion from their house accounts at current prices. So what it is net of the shorts that can be covered inside this COMEX against the specs, the entire naked short load sits on the Fed's book, and it has been accruing. And there's just a long history of gold market interventions, too many to recount really, but since the inception of the COMEX, there have been occasions where this CME LBMA run casino has had to be bailed out from complete collapse. And these bailouts have become more frequent. And this is really what we're trying to drill down into. The 3 most notable CME LBMA officially contrived bailouts were first revealed after long-term capital management collapsed in 1998. Now, people will remember that. It was a huge issue. And while the too big to fail banks exposed to billions in derivative losses, not just gold, billions in complete derivative losses, they were able to be bailed out by the US government in 2000 with freshly printed fiat dollars. Hey, what do? You just print them up. And these too big to fail bullion banks, but they'd also been caught short, i.e., they'd loaned out 100 tons of physical gold, and it was no longer in their possession. Now, unlike fiat, gold can't be printed, and having to buy back over 100 tons of gold at market would have collapsed. It would have driven the gold price, the global gold price, significantly higher. And there's just no doubt it would have collapsed the lead bullion bank, Goldman Sachs, and in turn, the entire interconnected daisy chain of too big to fail bullion banks. If there was ever any doubt of gold price suppression, Bank of England Governor Eddie George put this to rest in this now infamous quote, and I'm going to read from it. So this is really just taken from the quote at the time. Quote, "We looked into the abyss. If the gold price rose further, a further rise would have taken down one of several trading houses," well, we know who that was, "which might have taken down all the rest in their wake. Therefore, at any price, at any cost, the central banks had to quell the gold price, manage it. It was very difficult to get the gold price under control, but we've now succeeded. The US Fed was very active in getting the gold price down. So was the UK. Okay, so those that deny there's any gold price interventions, put that to rest right away. And so really what we're saying here, at 100-to-1 leverage, so this really really gives the game away. At 100-to-1 leverage, that was subsequently confirmed by both the Reserve Bank of England. They reckon 92 ounces of traded for every ounce of gold held, along with industry apologist Jeffrey Christian, in a recorded and still available on the CFTC website. That was a recorded meeting in March 2010, stated 100-to-1 paper to physical leverage, and he accompanied by a glib "so what" statement. So large was the leverage unwind, though, that even if you accept the 92-to-1 and 100-to-1 leverage ratio, that equated to between, think about it, a staggering 920 to 1,000 tons of rehypothecation exposure, which meant that even the forced sale of the 400 tons, which was half of all the Bank of England physical gold reserves, even the sale of that to bail the banks out was insufficient to halt a subsequent $1,600 per ounce rally over the next 11 years. And as far as official interventions are concerned, we don't really count the 2000. We're looking at these interventions. We're not really counting the 2008 financial crisis as an actual intervention. The Fed was far too busy saving the daisy chain of too big to bail banks from imploding their entire debt-saturated the whole debt-saturated financial system was imploding. And they were really busy trying to sort that out. And while the 2008 financial crisis saw gold briefly retrace from 1,000 to 700, this sell-off was actually largely due to leveraged paper gold, along with every other liquid asset class, being sold to meet massive stock market margin calls. And really, it was doing what it was supposed to do on the box. And it should be noted, though, that these paper market sell-offs, in any of these paper market sell-offs, not a single ounce of physical gold was ever put up for sale. In fact, quite the opposite. It was later proven that the global South central banks were alchemizing this paper-driven discount. Hence, the very strong rebound rally that followed over the next 3 years into 2011. Now, the mainstream media only ever mentions outflows from the GLD ETF. You remember, we've done episodes about the GLD, the illusionary world of the gold ETF. The mainstream media say, oh, well, look, GLD's emptying out. That means there's a lack of interest in gold. But really, what's not able to be squared off inside this siloed COMEX spec GLD redemptions, which to cover off these, as the Fed then works inside the casino, these are related. So what the part that isn't related, it illustrates the exact opposite that's going on. Paper gold is actually, when we see a withdrawal, paper gold's being demanded for physical delivery outside this ring fence. Now, putting the 2008 to 2011 rally aside, the second extremely counterintuitive, very large, officially orchestrated bullion bank bailout followed just 2 years later in April 2013. And as we highlighted recently, it could be last episode or the episode before, this was when the President's Working Group was scrambled together on the 1st of April 2013 to, out of thin air, generate sufficient paper gold supply to be able to rescue the LBMA bullion banks who still, using 100-to-1 paper to physical gold formula, had once again been caught naked short gold and unable to honor very public client physical delivery requests. And it became so public, the President's Working Group came in within 24 hours and they needed to do something because the system was about to break again. Now, we looked in absolute granular detail at this tidal wave of paper market gold supply, forcing a synthetically driven $500 paper price smash, and how this ultimately ran into the first evidence, actually, that China intervened in the gold markets, stepping in massive size to underpin their well-telegraphed 2010 gold marking efforts for their citizens to buy gold. Remember the big billboards, house-sized billboards, buy gold, invest in gold, you'll benefit from the rally. I'm not even referring to the one that happened this year, but essentially what they did was step in and protected their citizens. Now, this was the only thing that halted this momentum-driven selling, and really these large discounted tonnage physical delivery outflows were exiting out of the West into the PBOC's coffers, forcing really a scramble by the president's working group to short cover pretty quickly. So that was the second official intervention that tried to support this 100-to-1 ratio, attempting to enable the 50 years of gold price control to continue. Then the third and final straw was the very last big-scale official gold market intervention we will ever see again. It was the event that signaled the 100-to-1 game ultimate's demise, which we looked at in granular detail at the time, and is still available to view in our March 2020 Live from the Vault episodes. March, April, May, June, we went through the whole process. But in summary, really, this was so obvious a bailout. What it was trying to do was offset a sudden excess, really, of global physical demand that could not be met by the cartel at a diluted 100-to-1 prices. Go figure. What a change. Nothing had changed. In this case, the failure to deliver was actually exposed when COVID refinery shutdowns actually froze global bullion supplies overnight. Okay, black swan event. And the reason I raise this now is that there are many more black swan events facing us now, including right now. And this refinery blockage in this case was once again, what it did is expose this 100-to-1 leveraged naked short over-the-counter liquidity providers being turned upon to actually deliver against foreign exchange gold paper longs they didn't actually have. So, in other words, you go on the spot market, I'll buy a spot. Oh, hang on a minute, can't get physical. Give me give me the bullion. No, they didn't have it. And their inability to short cover. So what they need to do is cover this exposure. They raced to short cover into to short cover these massively leveraged naked short so-called hedges. So we were seeing paper gold, and the spot market is being hedged by paper gold in the COMEX. And what we witnessed was the LBMA CME price rigging conduit finally completely break, evidencing an unprecedented, think about this, $100 bid-ask spread to cover these problems, i.e., I'm being demanded physical delivery on, I'm a bank that could be put out of business, the first thing I have to do is cover my risk. It cost me $100 an ounce. And when you have tonnage out there, this was a massive problem. And it actually caused a lot of second-tier liquidity providers to disappear. And the first-tier banks were bailed out. This was the final proof of a continued 100-to-1 leverage revealed to the central banks and sovereigns and institutionals. And with the cat out of the bag, central banks turned on the paper markets in earnest to raid them. And that's never stopped. But with a complete collapse of the paper markets on their hands, officials had to step in. But this was the final straw that spelled the demise of the 100-to-1 paper swamp. And at this event, this came very, very close to triggering literally trillions, possibly 70 trillion of offside gold derivative bets to default. Bear in mind, it's not just the 15 trillion a year in the over-the-counter markets, it's the related derivatives that belong to them. So this was sufficient to collapse the entire daisy chain of cartel too big to fail banks. Well, full circle, back to where gold was bailed out 20 years before at $300 gold. However, as we highlighted at the time, This was to prove to be the last globally coordinated central bank assisted intervention, and it was the catalyst that forced the Bank of International Settlements to bring forward and implement these Basel III net stable funding ratio standards, which finally took effect at the commencement of 2023 trading. In fact, from this point forward, every single bullion bank and the BIS moved to go long to physical gold well ahead of net stable funding standards being imposed in January of this year.
Now, Andrew, I'm pretty sure this next question is on the top of everyone's mind right now as they're listening to here. With the Fed being the only central bank short gold, where does it leave the Fed?
Yeah, good question, Shane. The Fed openly intervenes in the dollar crosses. Of course, they do in all the foreign exchange crosses, whether it's a dollar, euro, dollar yen, whatever it is, on a regular basis, and in compliance with each other. But with gold also a foreign exchange cross against the dollar, the Fed relies on paper gold to manage the dollar against gold. And this is what led them into making this catastrophic error in March 2022, when they employed paper gold to fight against Russia, backing the ruble-denominated energy trade with physical gold. And get the difference. The Fed was selling paper gold while Russia was accumulating physical gold in exchange for oil commodities, severely impacting this 100-to-1 ratio. So you've got a double whammy going on here. And this ill-advised sanction pushback evidenced the Fed taking on the entire load of these paper market short bets, with every single other central bank except the Fed shedding paper gold exposure against themselves. They didn't want to be involved in a short position against gold. So really, to sum this up, the month-long Fed-driven action that we evidenced throughout all of September was 100% driven by the Fed, who view gold as increasingly competing with what we call the three-card treasury shuffle. So where they issue treasuries and you've got competing. So you don't want that, the gold competing against them. So really, gold rising, a rise in the gold price is never really looked on favorably by the Fed insiders attempting to cap gold in the paper markets. This management is reliant and limited on how many speculators can take the bait. I just want to make it so clear so people understand it's that simple. Bottom line, these foolish speculators had stretched the paper to physical market gold market disconnect to such extremes that this had presented us an opportunity not seen since the lows were made in the 1600s in November of last year, when the Bank of International Settlements squared all their positions. Now we have reached that inflection point where really the 100-to-1 leverage simply has to be unwound.
Yeah, now, Andrew, this sounds very bullish going forward. So what are you seeing now in the wholesale markets?
Yeah, Shane. So let's fast forward to now then. Looking forward, led by Russia, chairing the swelling group of BRICS nations in 2024, an ever larger percentage of global energy trade alongside hard commodities will increasingly get settled in non-dollar denominated multipolar jurisdictions. Now, even ahead of Glasniev's gold-backed commodity trade being formally launched in the first quarter of 2024, physical gold transactions are being priced and settled outside of the CME LBMA paper market ring fence. So we are privileged to be reaching the inflection point where we will be able to look back at this 50-year gold price suppression, reversing into the need for central banks to revalue gold assets on their balance sheets. Now, much as we knew that the implementation of Basel III NSFR compliance alongside gold being revalued as a first-year asset class would mark a major inflection point by the end of 2023, and 2024 is only 67 days away after this episode is published on Friday. So with gold increasingly being valued on a one-to-one basis outside of the Fed's scope, we will evidence a real physical gold price to emerge from the dregs of a broken paper market. Now, it's as simple as this. The gold price will be determined by a physically settled supply-demand balance. That is the price a global seller is willing to actually part with their physical gold in exchange for cash or other goods, could be a commodity. So in other words, the only remaining paper-settled futures market, that is the COMEX, will have to become deliverable, or it'll just be raided for every last leveraged ounce it has. US traders that are currently siloed inside this rigged CME regulated paper market, which they were since 2013, may as well release them from their siloed prison. And really, that's what it is. And you know what's going to happen? This 50-year margin game will fold because that's the only place where it still exists. Now, we'll look at these same actors' infamous May 2011 silver market interventions in our next episode.
Awesome. Now, Andrew, we got a question from our trader group, and they want to know, like, what's happening here with these COT reports? What are they saying now?
Yeah, for those that want to drill down, very short term, the latest COT reports continue to confirm this change in behavior that we've been witnessing. And once again, the specs fail to read that the wholesale market footprints evidencing this. That's why these market making insiders were going long against them, i.e. taking the long side of their short bets and setting them up for a rinse. And this finally began to play out last Friday, when really this black swan event unfolded in Israel. Could be any other black swan event, but it really, when you have that much leverage out there, anything can trigger a problem. After being tricked into dumping all their bullish bets, these last three extremely stale COT reports that you've talked about Shane, that verified our assessments that these specs had become so wrong-footed that they doubled down on their short bets, betting on a lower gold price. And they'd moved full on gross and net short. In other words, completely so exposed to a short rinse, i.e. somebody coming in and rinsing them. It's so rare to see that. It's such a rare event because normally they would have some kind of longs offsetting something. They weren't, completely short. And who are they short against? They were short against the pit managers running the COMEX, betting. I mean, they have a betting book against them. And we will now look really at the changes in market behavior following. What it's doing is showing us the changes in the market behavior following the house ringing the register on these naked short speculators. So short-term geopolitics are assistive, yeah, but it has to be realized that the real bullish driver is physical gold and of course silver demand. And the recent outflows of real bullion are not coming back, and they've severely impacted the paper to physical balance. So the paper market element is always vulnerable. So we may see some short-term pullbacks, which we, along with other central banks, will simply capitalize on. And as can be seen by the COT reports, which anyone who wants to look at them, specs were caught naked short. And despite being severely rinsed on Friday of last week, and so far this week as well, this was short covering, not fresh longs. So in other words, they were just rate covering position. They weren't adding longs that could be nailed again. And in fact, we actually hear of a leveraged short gold and silver fund that got margin called last Friday that wiped them out. I'd really like to get more information on that, but I'm pretty sure from the information we got that this really happened. Now, if that happened to them, there must be others on the cusp. And as we summed up last time, anyone shorting gold at this juncture is playing with fire and are setting themselves up for a religious experience. So with that said, there's just one question, guys, left to ask. How much physical gold and silver do you own?
All right. Thank you, Andrew Maguire, for talking gold. And remember, to our Live from the Vault community, buy physical, and make sure it's backed 1-to-1, and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets, they're not the same. Don't be fooled. And there you have it. That's all we have for you today on another amazing episode of Live from the Vault. Please help spread the word about this channel by hitting that like button if you haven't already done so. Share this information and subscribe for sure. And if you click on that little bell right there, you'll be notified in real time as each episode goes live. And with that, we'll see you next time right here on Live from the Vault. See you then.